Hello traders, welcome to part 3 of the volume spread analysis series. The goal of today's webinar is to cover market testing in VSA, what it is and how you can trade it. If you haven't seen part 1 or 2 yet, then I would recommend going back to watch those videos after you've seen this one. So here we have the market cycle. Institutions operate through cycles of accumulation and distribution as shown on this image. I'll cover the stages of this cycle from a high level before we dive into the market test parts in green later in the presentation. The length of these cycles can vary significantly and they can be seen across many major markets. The process begins on the left with the accumulation phase. This is the process of buying as much of an asset as possible without moving the price significantly until there is little left to buy at those prices. Usually this happens after a significant bear move. Once the selling has dried up and enough of the asset has changed hands, the larger players will look to mark up the price. At this point, the market will be tested to see if it is ready to move higher. The spring and the test of supply comes next, although this isn't always present. When the market is in a spring position, this is where the prices have been pushed lower by the larger players to below the bottom of the accumulation range. If the market has responded to the spring with a rally, there is likely to be a test of the spring. This is where large players test supply to see if there are any more sellers waiting on the sidelines. By pushing prices lower, this gives sellers another opportunity to provide supply to the market, who may then rush in to sell before prices get any lower. If no more sellers, the market is ready to move higher. Next, we enter the markup phase. This is where prices are then pushed higher to a stage where there is significant buying volume from the general market participants, up to a range where they can begin distributing. By pushing the prices higher, they encourage other participants to join the bull move, ultimately to provide liquidity for the next stage of the cycle. This is the distribution phase, where institutions are looking to take profits from the accumulation phase. They may be looking to sell within a specified range, but not looking to move prices too significantly. Once almost all inventory is sold, a bear market can begin as the buying now lacks institutional support. At the end of the distribution phase, we often see an upthrust followed by a test of demand here in the green. When the market is in an upthrust position and the market has responded to the spring with a sell-off, there is likely to be a test of the upthrust. This is where larger players test demand this time to see if there are any more buyers waiting on the sidelines. Larger players push prices higher, giving any remaining buyers another opportunity to rush in to buy before prices may seem to move even higher. In the markdown phase, prices are pushed lower by the larger players to a new accumulation phase can begin once again. We can see that there are typically 2 parts of the cycle where the smart money uses market tests, usually at the end of the accumulation phase and at the end of the distribution phase. These are the parts that we will focus on this video. We'll look at how to identify them and also how to trade them. So what is market testing? Market testing is one of the most important concepts in VSA. It's used by the larger players to either confirm a current trend or test if the market is ready to move in a particular direction. At the end of an accumulation phase or during a markup, if a spring occurs, larger players will test to see if there is further supply to hit the market or if there's any interest in lower prices around those key price levels. If there is no more supply, i.e. there has been a successful test, then they can begin to move the price higher with less selling resistance. If the test causes additional supply to enter the market, then it is considered a failed test. The opposite is obviously true for the test of demand, which is at the end of the distribution phase or during a markdown. So here's another analogy which I think better explains the market tests. I think these are a good way of explaining somewhat difficult concepts. So consider a fisherman that dips the bait into the water to lure out the fish. The fishermen are the larger players in the market. The bait going into the water is the market test. The fish in the water are other unsuspecting traders waiting to trade. The fisherman is luring out the fish using bait, which is the same idea as market testing. In a test of supply, at the end of an accumulation period, the larger players push the price lower to lure out any remaining sellers waiting to sell, who may then rush in to sell in fear of the prices may move lower. When there are no more fish in the water, i.e. when there are no more sellers wanting to sell, the fishermen can move on to another area, and also the larger players can begin to push the prices higher. Let's now look at a test of supply. At the end of the accumulation phase, the larger players create a spring, pushing price below the accumulation range to mislead retail traders who believe lower prices and a lower low is imminent. If the market recovers, the larger players will then perform a test of supply, where they will test the supply for the very last time. Here they push prices lower to make sure that all the supply pressure has been absorbed during the accumulation phase and the spring. These periods are also known as bear traps, which I'm sure many of you have heard of in the past. Here, the smart money is testing the strength of buyers and sellers around these key price levels. If there is a successful test, i.e. there is no more selling pressure, the test of supply is likely to be followed by a rally pushing prices higher to a new higher level. If the market test results in a considerable amount of supply coming into the market, the test has failed and the market is not ready to move higher. Therefore, another test may be on the way soon. The supply must be removed before the market can begin a substantial move higher. In this image, we can better see how a spring and market test may develop at the end of an accumulation phase. Generally, when looking to enter a long trade, we want to look for a high quality test of supply. This is where first the market test puts in a higher low than what was seen or recorded during the spring. And here we can see that in this image. The test has recorded a higher low versus the lower low of the spring. Secondly, we would also want to look out for narrowing price spreads and decreasing volumes during the test. If we see both of these during a test of supply, we should have more confidence that prices may move higher. Then a long position will have a better chance of being successful. So let's look at an example on the chart using the VSA indicator. Here we can see an example of a successful test of supply at the end of an accumulation phase. We see high volume and large price spreads during the spring. And in the test of supply, we are seeing declining volumes and we're seeing a narrowing of the price spreads. So the price spreads are the difference between the high and low, which we see during the spring, are greater than the spreads during the test of supply, which on average are lower. We can also see the volume is much higher during the spring on average, whereas the volume is declining during the test of supply. Once the test was passed, we can see that the price was moved higher onto the markup phase. Now, if we're looking to take a long trade during this market test, we might be looking to set our stop just below the bottom of the spring. This stop being hit would mean the test of supply had failed, when we would then want to wait for another market test to be successful. Now, the test of demand is very much the opposite of a test of supply. At the end of the distribution phase, the larger players create an upthrust, which is the opposite of a spring at the end of an accumulation phase. This pushes price above the accumulation range to mislead retail traders who believe higher prices and a higher high is imminent. If the market falls after the upthrust, the larger players will then perform a test of demand, where they will test that there is no more demand for the last time. Here they push prices higher to make sure that all of the demand has been absorbed in the distribution phase and the spring. These are also known as bull traps, which again many of you have probably heard of before. Here the smart money is testing the strength of buyers and sellers around these key price levels. If there is a successful test, i.e. there is no more buying pressure, the test of demand will likely be followed by a fall in prices to a lower level. If the market test results in a considerable amount of demand coming into the market, the test has failed and the market is not ready to move lower. Therefore, another test may be on the way soon. The demand must be completely removed from the market before a substantial move lower can begin. Now here we can see an example of a successful test of demand following an upthrust at the end of a distribution phase. During the test of demand, we see declining volumes over here and a narrow price spread relative to the upthrust, showing a sign of weakness. So if we look during the upthrust, we can see the price spreads are generally wider. So the difference between the high and low is on average greater than the spreads during the test of demand. In addition, we can see that the volumes on average are greater than we see during a test of demand where we see declining volumes. This tells us there is less probability of more demand entering the market and prices may be ready to move lower. If looking for a short trade at the end of the test of demand, we would again want to set the stop just above the high of the upthrust to give the trade enough room to breathe should it work out. It's important to understand that the examples I've shown in this presentation are relatively clear to show the concepts. However, this will not always be the case when you are analysing the market. You will not always see these springs or upthrusts clearly, as they do not always appear, but the point of this presentation is to recognise them when they do appear and therefore make sure you are more informed on what to do and what might be the best course of action to take. Thank you for your time and attention. I'll see you in the next video of the VSA series.